I'm now delighted to begin our opening panel of the day, Navigating Your Wealth Through Uncertain Times. And for this, I am delighted to be joined by the co-founder and CEO of Netwealth, Charlotte Ransom, and Steve Webb, former pensions minister and now a partner at pensions consultancy LCP. Thank you both so much for joining us today. You've obviously just been listening to this enormous shift in the economy that we've been talking about. And so I'm going to start by asking you both the same question, and Charlotte will come to you first. All of these changes, all of this upheaval, what do you see are the main challenges and the main opportunities that come from all of this for people?
Well, as you rightly said in your introduction, and thank you for that, James, I mean, there's been huge challenges for people just to absorb the amount of change that has been thrown at them, and of course built into that the volatility in the markets. And that is something which very few people are accustomed to or enjoy in any respect. So I think we have all lived through periods of an extraordinary period that has, as you discussed, sort of restrained us in our normal habits, and at the same time has wreaked havoc in terms of our retirement savings and other investments, and so has led us all to start thinking a little bit more about what actually have we been doing during this period and what can we do to make sure that we are on track. And I think maybe that's the opportunity, that we were all locked down with our families but with our money, and that finally perhaps a subject that is often quite a long way down people's to-do lists has been brought further up as people have been more focused and really trying to think about the different aspects to their savings and investments and how well set up they are for the goals they have in mind. So I have huge sympathy for any financial consumer given the amount of data and information that's being thrown at them. And of course it's interesting because we know that often commentators are preempting what they think may come. And in fact, if we remember back to the end of 2019, everyone thought among the commentaries that interest rates were as low as they possibly could be. And here we are almost 2 years later, and they have been either at the same level or lower. And equally this year, at the start of this year, there was an awful lot of commentary around inflation and how we would deal with it. And we are in a very similar place now. And I think my only point that I'm trying to make here is that as investors, I think we have to step back a bit sometimes from the headlines and step back a bit from the amount of anxiety that is sort of being built around some of the commentary and think about what we're trying to do. And very often we have a long-term outlook. We're actually trying to do things that are going to take multiple years, sometimes multiple decades. And that throws a very different light in terms of how you then go about thinking about your personal wealth and organizing yourself through these, sometimes very difficult circumstances.
It's very hard, isn't it, to when you see the stock market moving so quickly, or when you get a text message on your phone telling you that your portfolio has fallen by 10%, as happened at the peak of the pandemic, to kind of keep that perspective that you're really dealing with the long term. Steve, what do you think are the main challenges and opportunities?
Well, it's interesting, as I think Charlotte and I both reflected independently on your question, and I had the same key phrase about long-termism. And I suppose the reason I come at that is thinking about when we, the government, as I then was, introduced pension freedoms. The whole focus was really on age 55, at retirement, whatever that is anymore, and wasn't really on the decades which then follow. We're not about any longer building a pot that you turn into an income for life and you walk away. We are talking about managing money over decades, over very uncertain decades. So, in the shift from defined benefit to defined contribution, all that longevity risk is now on the individual. And it's hard enough to manage a pot for 20 years. It's even harder when you don't know if it might be 10 or 30. So an awful lot about long-term management, not knee-jerk reactions to short-term changes. And I suppose one area where I think that's quite important is there is a danger that we make choices at retirement and then we don't revisit them. So there's a lot of talk about a midlife MOT, halfway through your career, you review career changes, financial position to date. We haven't yet started to think about a mid-retirement MOT. And I think increasingly we'll need that. Maybe you don't buy an annuity at 58, but at 72, do you still want to be juggling your portfolio? A bit of longevity insurance might look quite good. And I think I would say we're in the like the early adopters of 5G or something like that. With Pension Freedoms, we're in that first cohort. They're all in their 60s, give or take, because if you were already that much older, you'd probably annuitised already. This is a cohort who are going before us, as it were, who will explore pension freedoms over decades, and I think that is an opportunity. You know, they're not locked into an annuity at ultra low interest rates, but faces huge challenges, which is why events like today are so important.
Charlotte, let me ask you about the pension freedoms, because I think that's a really interesting point that came up, because we were, with my team in the office, we were pondering about what life would have been like for the pandemic situation would have been like for people had the pension freedoms not been here, because we've had this huge lifestyle change. And in a way, the timing could not maybe have been better, because suddenly with this huge lifestyle change, we've got these huge changes to the rules on pensions that allow people to plot things a lot differently. How do you think the fact these different decisions that people are making about whether or not they work longer or shorter or change their working patterns sit with the pension freedoms and the way that you think about your money?
Well, so this to me is a little bit about what we can control versus what we can't control. Because I think actually, no matter which part of your wealth you're thinking about, it's always worth understanding what you can actually do about it. And going back to a point that Steve made, one of the things we can't control is longevity. Another thing we can't control, and is a topic that's being talked about a lot, is inflation. And then thirdly, as we've just lived through again, we can't control the markets. But what I think is really relevant when we're thinking about pension freedoms and thinking about long-term wealth planning is now to take into account what you can control. So those three things I mentioned, you can model for longevity. You can look at the impact of living for a decade longer or being in the 5% that get to 100 years old plus. You can model for inflation, which again, there is an expectation it goes higher, but for how long? Will it be a sustained level or not? In terms of the markets and what we can control, we can make sure we're invested. And this is something that you've written about before, that it's so important, no matter the fact you will experience ups and downs, to be invested. And also to take advantage of the tax wrappers. So pension freedoms is a good thing, but make sure you're maximising your pension. Make sure you're maximising your ISAs, and not just you, but within your family unit and across the different family members. And then, of course, the other thing that is within our control is to think about fees. And I think this is one of the things around pensions freedom that is very, very good, that people now are able to focus more on what can I control, what can I do to make my retirement as long and healthy and fruitful as possible, and what is it that will be perhaps, you know, the thing that makes the difference to that. And I just bring an example of the fee issue, for example, and that is that for somebody who maybe has £1 million pension and they're in a 60-40 sort of middle risk type of portfolio.
Explain what you mean by 60-40 mix.
So 60% in equities, 40% in fixed income, probably globally diversified, which would typically sit somewhere along a sort of middle ranking risk level. That portfolio, if you were to reduce the annual fees on it by 1%, would give the holder an extra 8 years of pension income. Now, if you think that most people's pensions are 20 or 30 years long, 8 years is a very substantial differentiator in terms of, you know, being able to accommodate those aspects that we were talking about earlier that are out of control. So I think there's huge pluses for people to be able to have more control and to be able to make decisions that they might not otherwise have done. It's very good timing in terms of interest rates being rock bottom. You wouldn't want to be forced into an annuity now. And I think, though, there are still aspects to retirement planning that people need to take very seriously in terms of recognizing the decisions they're making and whether they're making the right ones.
So take back control.
I've heard that somewhere before.
Yes, we've all heard that before. How do we take back control when we don't? How do we assess what this new normal is going to look like? How for a normal person, how do they kind of plot what they think is going to be sustained? I mean, I think Charlotte mentioned inflation, and that is a really important conversation to have. And there seems to be a huge difference of opinion about whether or not the inflation that it looks like is going to come into the economy is going to be sustained, or whether or not it's going to work its way out in a year or so. How do we figure out what is going to be normal as we try to take control of our own money?
And I think that's where the long-term perspective comes in again. I mean, you had the Bank of England earlier this month sitting down saying, we've got a target of 2% inflation. It's already over 3. We think it'll go over 5. And yet for now at least, we're holding off on interest rates because we just don't think this is our long-term shift. It's a sort of bottleneck type issue. So if even the Bank of England are kind of saying we're not sure this is a permanent shift, I think we as individuals have to avoid rushing to assume that the thing that's just happened is the new normal, because it's striking just how quickly these things turn. You know, I was just reflecting on the fact that, you know, 10 years ago, I remember as a government minister, companies coming in and saying to me, these low interest rates, they're messing up our company finances, we're having to shovel money into our pension schemes. Can't you sort of fudge it for a bit, because we all know it's temporary. 10 years ago, interest rates are now lower than when they came in and saw me, kind of thing. So, you know, that was a case where it really was a change for the long term, but very hard to spot at the time. So I think trying to work out whether, you know, things like, you know, if you're investing in corporate property, you know, big office blocks in the centre of cities, well, there must be a fair chance that that market is substantively changed by what's gone on. But there are other things, as I say, you know, the spike in inflation could just be a temporary, you know, exacerbated perhaps by Brexit, but, you know, the global recovery from the pandemic putting demand pressure on, you can kind of see why that might be more temporary. Now, you know, none of us know for sure, but I think that you know, what a company pension fund would call it hedging your bets, basically, having some sort of buffer, so that if things go significantly differently to what you thought, and if that would be something you couldn't cope with, you know, trying to make sure you're investing in line with what you can cope with and in terms of risk, I think is the key. Just, James, if I may, just as a PS on what you can control, the beauty for me of pension freedoms is you can stage what you do. You're not saying, this is my retirement date, state pension this day, company pension this day, annuity this day. You can have multiple pensions, take chunks at different, and that gives you that ability to flex. So if your punt on what's permanent and what's temporary turns out to be wrong, you can adjust. You're not making all or nothing decisions anymore.
I mean, you've talked about MOT, we've talked about the idea that you should be checking in and out. I think it's really interesting, isn't it? Because we talk a lot about life stages in people's life where, you know, you want to buy a house, or you have children, you get married, and not necessarily in that order, and then you kind of, you know, kids go to university, and there are all these life stages that we seem to focus life events around, and then retirement is the next one, but we don't talk about the life stages after retirement particularly, even though it may be 20, 30 years. How do we, I mean, we talk about kind of MOT, a personal MOT, but from a kind of financial advice point of view, it seems like there are key moments of dipping in and out. How should people think about particularly later life financial advice? Because I think most people think about it at the point of decumulation, which is the point at which you obviously think about taking all that money you've accumulated. But how do we then go about thinking about financial advice and what you should be paying for or not paying for as we go from that point onwards?
Yeah, I think it is a very interesting point. I mean, the typical time we find people are looking for financial advice is in that run-up to retirement. So not necessarily at the point of decumulation, but in the sort of 5 years in the run-up to that. And of course, the time and stage at which people aim to retire now is all over the place. I mean, there are very differing views on that, and the pandemic has been one of the things that has changed people's opinions. The other big times that we see people looking for advice are other life events, like you mentioned. So it may be divorce, it might be an inheritance. It's a sort of a significant change in what might have been, you know, the order of the day. And one of the things that I think is absolutely crucial for people to recognize is that advice doesn't have to be something they pay for every year. And for most of us, advice every year is overkill. If we're doing the things that we should be doing, and we're making sure we take advantage of the tax wrappers, and we are engaged with our finances to a certain point, then actually there are some clear points in your life where advice is advisable. And, you know, I love the idea of a mid-retirement MOT, for example. There's no reason to think because you got your you know, assets in shape at whatever age you decide to retire, 60, 65, that you shouldn't check in again. The other thing that we found when we're giving advice is that when people think about their retirement pot, it's quite nice to be able to think about which bit am I going to draw from, and actually is there a part of it that I may never touch or I might not touch for a long time. So coming back to this notion of flexibility and checking in, it's quite nice to be able to see you might have a relatively low risk portfolio that is allowing you to take your monthly income and to, replace the salary that you were used to, and have another pot which is actually doing something rather different and is perhaps experiencing greater volatility but greater potential for market returns to drive you towards later life and perhaps be there to help pay for other expenses. You may not be traveling at that stage, you may be thinking about care home fees, depending on whether you're in your late 80s, late 90s and so on. So I think advice is something people should expect to engage with, but I think it's off-putting sometimes for people to think, okay, this is just going to get boiled into whatever service I'm being asked to pay for. And typically it's at least 0.5% that is boiled in. And that to me is too much to be taken on an annual basis. So I think people should alternatively be able to opt to pay for hourly advice during those points of their life when it's most needed. And of course, things can change as well. People can take hourly advice and then decide 10 years later on, actually, I'd like annual, and vice versa. But I think that as an industry, the wealth management industry hasn't done well at giving people that level of flexibility and sort of transparency around their own situation and how they could be handling it.
I always think the really interesting thing about fees and ongoing fees is people don't realise how they can erode your money so much. I mean, we always talk about an extra 1% fee over 30 years takes 50% of your profits. It's quite staggering, isn't it? Because it sounds like little numbers, but they can very easily lead to big numbers. So, Steve, Charlotte's talking about pots and having bits of money here and there that you dip into at the right time. Of course, an important part of this equation is going to be figuring out what type of pension you've got, because some people still have defined benefit pensions, final salary pensions, or what we call career average pensions, alongside, they may have bits of them from some jobs, they may have other bits of pension over here, and a little pot they've been saving over here, and a financial advisor pot over here. How should you go about thinking about these different types of pension that you've got and how you should be using them?
And I think we're at a period at the moment where people have, as you say, a bit of everything. If I think about myself, I will have a state pension of getting on for 10,000 a year, as will my wife. And there is an issue, obviously, about us planning jointly, and hopefully we'll remain married until one of us pops our clogs, but we might not. So there's an issue about separate financial planning and joint financial planning, which we probably don't think about enough. But take myself, so a state pension, a past role which provided a salary-related pension, but that's now finished, and a pot of money pension, a defined contribution pension. And so for me, unless I move between those pots, I'll have the secure income from the state, all being well, possibly have to work a bit longer for it, because the thing that you really don't know about the state pension is when you'll get it. My defined benefit pension payable in principle at a certain date, but more flex within that than people realise. I could take it early and lower. I could take it later and higher. I could take more of it or less of it as a tax-free lump sum. So it's worth finding out what flex you've got within DB, which people often miss. And then the DC pot, which provides the flexibility, the one-off lump sum, perhaps the ability to take a bit more risk because I've secured my income from the other sources. But of course, as it happens for me, my balance between those feels kind of quite good. But for some people, they'll be a bit heavy on one or other side. So they might, for example, have 2 DB pots, 2 defined benefit pots, and no pot of money over here. And there might be a case, individual specific, take advice, listen to it, but there might be a case for converting one of those fixed pots into a flexible pot, because then you can do things with that, provided you've secured your base. So I think pension freedom is both a threat and an opportunity. It's the chance to do this. But I hear, and your mailbag must be full of people saying, well, I know I want to do this. This stupid advisor's told me not to. They won't do it. Where can I go to someone stamp the form so I can do it? And that obviously sets off all the alarm bells. So it's right that there's an advice requirement, and it is increasingly hard to find advice. One thing I'm keen to promote is pension schemes helping their members source reliable advice. Because for me, they can source a legitimate advice firm who'll charge relatively low cost, if no cost, and then the member's got a bit more confidence than just kind of Googling somebody and you just don't know who you're going to end up with.
Yeah, I think employers really have and hopefully as one of the things that we've seen from the pandemic, we'll see more employers take responsibility for helping their staff navigate through some of these issues. Now, inflation, let's kind of tackle it head on, because it's a really interesting issue that's going to come up. And it's one that kind of persists even when we don't have very high inflation. It's one that we should always be aware of, isn't it? And I think particularly in uncertain times where we have very volatile stock market that you were talking about, Charlotte, at the start, it can be sometimes people's inclination to kind of seek a safe haven and try and find a bit of shelter from the storm in the stock markets. How do we go about thinking about saving versus investing and the various kind of pros and cons of that?
Yeah, it is such an important thing for people to think about, because a little bit like we were talking earlier, you can have so many headlines that really are terrifying sometimes, and there's this sense that there is no safe haven, there is no safe place to be. And to some extent, there may be some of that going on now. I mean, if people feel that inflation is likely to be significant, going higher, and perhaps persisting, and at the same time that perhaps equity markets are at all-time highs, and therefore how much further can they go, there might be the sense of, well, I'm just going to sit in cash. And that, to me, is just the worst thing to do. And you know, it's fascinating. I was looking at the ISA stats for last year. Over £600 billion are in ISAs, and over 50% of that is sitting in cash. And so people have done the right thing by doing their ISAs. And then the average holding period for ISAs is well over 5 years. So that's just a little snapshot of the UK community and how we can sometimes do the right thing, but don't go the whole way and leave yourself sitting in cash. So we all know cash is a bad place to be when inflation comes. I think the point about the stock market is that, again, it comes back to time frame, and that as long as you have a sufficient time frame and you want to perhaps dampen out the real spikes, sort of both positive and negative in stock markets, and therefore have something which is globally diversified, gives you some some smoothing, if you like, around the world in terms of the type of equity returns that you can expect to receive, then I think actually inflation can be a good thing for stock markets. And they have already expressed a pretty significant capability of being able to work through the different sort of headwinds that are coming their way. So it's not to say that there won't be volatility. It's not to say that people shouldn't expect to potentially find their portfolios are worth less before they're worth more. But I still would strongly advise your readers, to be invested rather than to sit in cash. I think the other point about cash is that we are always there for too long. So there's always a reason to have a certain amount, usually a 6 months to a year's worth of cash to cover all eventualities. And again, in the pandemic, we saw that was really pretty critical, so that people didn't have to crystallize losses by selling out of their investments. But as we know, the years go by and the cash holdings remain. And right now we're paid next to nothing on our cash. So I think that we have to accept there are going to be investing headwinds almost always, and that we need to then line up the appropriate level of risk versus the different goals that we have for our money.
Steve, how do we... So staying invested seems like a really kind of great takeaway that I think lots of people can take from this. Particularly, we had an email from Jack Quick, who's asking how best you combat quickly rising inflation as you move into retirement, and I think that kind of answers that. But one thing I'm really interested in is, and I think you touched on this a little bit earlier, is that we tend to think very much individually about planning our retirement in these kind of uncertain times. But actually, there's a bigger picture here, isn't there? There's partners, and there's children, and there may even be even older parents that we have to think about increasingly as we get to retirement. How do we think about what we should be doing with our money? Thinking about the kind of family unit in particular.
I'm always amused when a relatively rich man, and it is always men, says, "Oh, I've hit all my limits. What can I do with my money?" And I say, "So, tell me about your wife's pension provision." "Oh, I hadn't thought about that." It's just there's the risk of being really individualistic about it, and then thinking purely about your own generation. And I think I'm very keen on breaking out of this mould where we pass on wealth when we die, rather than pass on wealth while we're still around to see our kids, for example, enjoy it. So this phrase, giving while living, coined, I think, by the American billionaire philanthropist, but perhaps we can be a bit like that. So if I think, my kids are in their 20s, I'm 56, I don't know what my life expectancy is, probably another 35 years, 30 years, something like that. Well, maybe my kids would love to inherit something from me at 60, but they'd certainly rather inherit it now. So thinking about what do I need on a precautionary basis, and then what does that leave, and can I do more for them at a key point when they're setting out on careers, buying houses, perhaps starting relationships and all of that, really. And then actually I get to see it as well. I had to smile. I wrote a column about this that I think you printed a while back, James, and somebody wrote in and said, yeah, I tried this. I gave my daughter some money towards the deposit. They bought a house with a guest room. I now get to stay with them. I don't know what the daughter thinks about that, but this, it's just so much more fulfilling thinking that your money, you can actually see the benefit and it's coming at the right time. And I just think the key then is, advice. I think the important thing about financial advice is you often don't realise what it's worth and why you need it. It's actually when you sit and talk to somebody and they talk you through your options and the perspective, and you suddenly, often your scales fall from your eyes, I think. Not, just the annual, shall I go a bit more into gilts or a bit more into Japanese equities type stuff, but just this bigger picture. And I think having a holistic conversation with somebody is incredibly valuable.
I think it's really interesting that you mentioned, obviously, the men, leading these financial conversations in a household and thinking a bit more about the household in general. Charlotte, I've noticed that in our post bag at the Times, we get a lot of emails from men discussing financial planning and a lot about investing and really like to see more women trying to engage with that. And we've got a question from Jen Archer, actually, who kind of raises this exact point. She says, what are the barriers that prevent women engaging in how to invest their money? And how can we change this and help educate and inform without patronising them? And I think that's a really brilliant question, because I think everyone's interested in making their money last as long as possible, aren't they?
I think it's a great question, and actually, it's a real worry that women do tend to be less engaged with finances than men, because part of the reason it's a worry is that women tend to have slightly more complex financial lives than men, because typically they will be the ones taking maternity leave, the ones having a disrupted career, probably the ones looking after elderly parents or elderly relatives, and then they tend to outlive their spouse. So for all sorts of reasons, it's very important to get this half of our global community engaged. There was a really interesting thing that the FCA survey, the FCA did last year, called Financial Lives, where they were actually trying to look at exactly this point about the demographics. And, I think Steve won't be surprised to hear that a lot of people aren't that focused on their pensions and the documentation associated with it. But while among men, it's typically 34, 35% who read it, understand it, and follow it, actually less than 13% of women do the same. So it's not high in either case, but for women not to be engaging with what this very important pot is going to do for them over the longer term in their latter years is very worrying. I think there's a reason why we're in this situation. I think, without wanting to sort of shine too mean a light on it, financial services were generally developed by men for men. And it was the men who were out, working, who were getting the salary in, and women were more often homemakers. That has obviously changed dramatically, but the wealth management industry hasn't changed as quickly. So that the whole relationship that is set up between the wealth manager and the consumer has been quite transactional, and the language is quite alienating. And it's something that women, I think, speaking as a woman, don't enjoy. So one of the things, for example, we focused on is allowing both men and women to think much more about your savings goals, what you're trying to achieve. Are you trying to put your kids through private school? Are you trying to think about how much you'll need in retirement? Are you trying to think about how much you might need to set aside for elderly parents? And that brings the whole concept of personal finance much more to life. And I think that starts to allow people to engage and feel as though this is something they understand, that they have a stake in. And if you're a multitasker, which lots of women are, suddenly this becomes part of that multitasking that you do. And I would say, actually, so from a Netwealth standpoint, we're just under 50% female clients, which I'm delighted by. So I think this way of thinking about and interacting with your wealth is as attractive to women as men. And I think it's absolutely critical that we can, make that the case far and wide across Britain.
And I think technology is going to help with that a lot, isn't it? Because the pandemic has been brilliant at kind of, not only we've had these great pharmaceutical advances that have helped us all and meant that we could all be in the same room together, but we've also had these great technological advances in terms of wealth management. And we've got a few more coming, I think, haven't we? Steve, there's a big one coming in pensions soon, hopefully, that will make life easier.
There is, so that the pensions dashboard is one of these things that's always been manana, but finally could be soonish. So there's legislation now that will say that within a few years you'll be able to go on a website, see your state pension, your company pensions, your private pensions and so on, and inevitably people say it's too slow and there ought to be other things on it and all the rest of it. But given the fragmented working lives we have, many people will have lots of pensions. People just lose them. You change job, the company name changes, the pension scheme name changes, you can't find anyone to get in touch with. I get letters all the time about this. I work for so-and-so and I can't find the pension. What do I do? So I think that will help. And if there's one place you can then go and the technology is good, people will start to engage. I'd just make one observation on this point, though, about women and men. I think one of the reasons why men have engaged more than women is that some women in marriage particularly have simply assumed that as long as the husband's got some wealth, that he's going to sort it for both of them. And as we know, particularly now, people don't always marry in the first place, relationships break down, people might have multiple partners. It's absolutely critical for each individual to have their own provision and not depend on anybody else.
So we've had a real whistle-stop tour there, Charlotte and Steve. Thank you so much, because, and I think the key messages are that we should be really staying invested as long as possible if we want to ride out inflation, keeping all our pots together, keeping on top of everything, and giving ourselves an MOT, not just in the kind of run-up to retirement, but also when we get to retirement as well. And there are so many issues here, and we've got a whole series of seminars today looking at income, in getting an income and investing, passing your wealth down through the generations, and what some of these big economic factors that are happening really mean to you. So thank you, Steve, and thank you, Charlotte, so much for sharing your thoughts today. And thank you very much also to the audience for all of your questions. I'm so sorry that we didn't manage to get through all of them throughout this session. However, the good news is that the Netwealth team are now available online. If you would like to discuss this topic, any topic that Charlotte and Steve have talked about, and have any further queries. Hope you've enjoyed the discussion and it was thought-provoking. And thank you once again to Charlotte and Steve.